An Errors and Omissions (E&O) clause is a type of professional liability insurance that protects insurance agents or brokers in case they make a mistake or omission while performing their duties. If an insurance agent makes a mistake in your policy, here's how it could affect the claim. What is an E&O clause? The E&O clause covers the insurance agent or company for negligence or errors they might make when handling your policy, such as providing incorrect information about your coverage, failing to include coverage that you requested, making mistakes in policy documentation or premium calculations. How the E&O clause affects your claim. 1. If the agent made a mistake. If an insurance agent makes a mistake, such as misinforming you about your coverage or failing to add an endorsement you requested, the E&O insurance protects them. This could allow them to cover the cost of any damages caused by their error. For example, if your agent mistakenly didn't include flood coverage in your policy, and you later experience flooding, the E&O insurance could help correct that mistake, either by compensating you or adjusting your claim to cover the loss that was missed. 2. Your claim process. If an error is identified, the insurance company or agent's E&O insurance might step in to resolve the issue. However, this doesn't mean your claim will be automatically accepted. The mistake by the agent doesn't automatically trigger coverage, so the agent's error would need to be corrected, and you might need to go through additional steps, like refiling your claim or updating your policy. 3. Limits and coverage. The E&O clause is designed to protect the agent or insurance company, not directly the policyholder, you. So, if an agent's error leads to a claim issue, the agent may need to work with you and the insurance company to make things right, but there may still be limits to how much can be corrected or paid out. If the error caused a major loss, for example, you weren't covered for something you thought you were, the agent's E&O insurance may help cover that, but you may still need to negotiate with the insurer to ensure you receive proper compensation. In summary, if an insurance agent makes a mistake that affects your claim, the Errors and Omissions insurance might help them resolve the issue, but it doesn't automatically guarantee that your claim will be paid out. You may need to work with both the agent and the insurance company to correct the mistake and ensure you're properly covered. The term estoppel in the context of insurance claims refers to a legal principle that prevents one party from making certain claims or taking certain actions that are inconsistent with their previous actions, statements, or conduct, especially when those actions have been relied upon by another party. In insurance, estoppel often comes into play when 1. The insurance company acts in a way that leads you to believe coverage exists. If an insurance company or agent gives the impression that a claim will be covered or processed but later tries to deny it by citing a policy exclusion or other reason, estoppel might prevent them from denying the claim. For example, if the insurance company acknowledges receipt of a claim, requests more documentation, or gives verbal assurances that a claim is covered, and you, relying on their actions, delay taking other steps or fail to pursue other options, the insurance company could be estopped, legally barred, from later denying the claim based on technicalities like missed deadlines or policy exclusions. 2. Preventing inconsistent claims. Estoppel can also apply to prevent either party, the insurer or the policyholder, from changing their stance on a matter if it would harm the other party. For instance, if the insurance company initially accepts a claim but later tries to argue that it wasn't covered, estoppel could stop them from doing so if you acted based on their initial acceptance. 3. Waiving rights or defenses. If an insurance company or policyholder takes certain actions, like offering payment or agreeing to cover part of a loss, estoppel could prevent them from later claiming they are not obligated to pay under the policy. For example, if the insurer acknowledges part of the loss and pays a portion of the claim, they may be estopped from denying the rest of the claim based on the same cause or issue, if they have already acted as if they would honor it. In summary, estoppel is a legal tool that can prevent an insurance company, or sometimes a policyholder, from going back on previous actions or representations that led the other party to rely on those actions. It helps ensure that neither party can act inconsistently in a way that would unfairly harm the other, especially when it comes to insurance claims. Order your copy of KISS Public Claim Adjuster Study at Amazon.com. Order now.